Hey guys, welcome back. I'm Jeb Smith, residential real estate broker here in Southern California, and I've got with me Josh Lewis of Buywise Mortgage. We're back this week doing another mortgage update. A lot of you guys have reached out to me over the last couple of weeks because we haven't done this update and asked us to do it, so we thought we would come back. And this week, talk again about interest rates, right? That seems to be the hot topic in the market at the moment. Everybody wants to know where interest rates are going. Should I refinance now? Should I wait? So we're going to let Josh speak to that again. In addition, both of us have had conversations about FHA recently and some of the pros and cons of doing an FHA loan versus trying to qualify for, say, a conventional loan. And so I thought we would use today to talk about that in a little bit more detail as well. And also that conversation will likely parlay into the difference in doing an FHA at 3.5% down versus doing a conventional loan at 3% down. What would be the advantage of one over the other? And I think that conversation will probably take us 10, 15 minutes or so, and we'll probably cut it at that. But before we dive into the conversation, I want to take a minute and ask a favor. If you're new to the channel, if you're just watching and you haven't already subscribed, do me a favor and hit that subscribe button if you want to stay updated on everything real estate related, from buying and selling to mortgage finance. We're here a couple times a week to keep you updated, and Josh's information will be below as well. So Josh, let's get into the conversation. Let's talk about interest rates, right? New big bold headline came out, I think yesterday or the day before. Interest rates are now below 3%. So what does that mean? Who can qualify for that? All that good stuff. Let's hear it.
Well, absolutely. Well, the good news is it's finally true for the most part. For most borrowers, rates are under 3% without paying a bunch of points or having to be the perfect spotless borrower. Most people get tired of hearing me complain about, for the last 3-4 months, we've had this headline every week: mortgage rates hit all-time low, but they were 0.02% lower than the week before. So for the most part, haven't really changed at all. But let's look at this. This is the bond chart. Doesn't mean anything to a borrower, but what I look at is here to the left. You can see within this range, they're just going up and down. But every week we're hearing rates hit an all-time new low. But back here around June 23rd, so starting about a month ago, we started this upward trend in bond prices. So when bond prices go up, yields or interest rates go down. So we really did start seeing some improvement about a month ago. We are at all-time lows for interest rates. And for most borrowers, that does mean a rate under 3% without paying a bunch of points to get it. What I wanted to point out is this red line here is just a level of resistance, and we've hit that now 1, 2, 3 times in the last 2 weeks, in the last 7 days, really. And every time we hit that, we get pushed back. So it looks like this is a fairly strong layer of resistance. We've got support below us, and all that is just a long way of saying rates probably aren't going to move much from here. They're at all-time lows, and we're likely to stay here in this range. I don't know that we're going to get a lot better without something to push things through that resistance, and we have nice support below us. So we've got a little range here that we're trading in. Probably the most important thing that I like to tell clients, they think there is an interest rate, and there really isn't an interest rate. There's a rate sheet, and it starts with a base rate, and then for every borrower, there's loan level price adjustments. The more you owe, so the higher loan to value on the loan, slightly worse the rate will get. The lower your credit score goes can impact that. The property type, a high loan to value condominium will have some additional hits. If you take cash out, it will be a little bit worse. So whenever you see anything advertised, an advertiser is always going to say, what is the perfect interest rate? Lowest loan to value, highest credit score, perfect property. And that rate does exist. But realize for 60, 70% of our clients, they don't fall into that category. So there's always going to be some adjustments and some more nuance that goes into it. But for the most part, your 30-year fixed conforming loans under 510, 400 are going to be in that 2.75 range with 0 points right now. So it is an excellent time. I don't know, Jeb, if you saw last week, Black Knight Data Services put out a report that 75% of homeowners are refinance eligible. And that's crazy, because if you remember back in 2013, 2014, we were doing a bunch of refinances in the 3.5, 3.625 range. We're like, these people will never touch these loans. They'll never have an opportunity to refinance. And now all of those people are eligible. Talked to a guy last night that we closed his refinance in January at 3.75. It was a cash out. It was a good rate. We're lowering them to 2.875. It's a pretty big difference. So just long way of saying rates are at all-time lows. If you're serious about it, talk to a professional that has multiple options and can kind of show you a few different ways of structuring your loan and help you work to what's going to work best for you.
No, for sure. And what I'm going to do is I'm going to link to a video here at the moment, because I talked about, in another video about, how your interest rate is calculated. So I go into it in a little bit more detail, basically what Josh just said, but in a little bit more detail. So if you want to know how your interest rate is calculated, how your interest rate might be a little bit different than, say, my interest rate or Josh's interest rate for that matter when refinancing, take a look at that. And then secondly, I get a lot of people reaching out to me directly in the comments, and I encourage you guys to do that if you have questions. But a lot of times they'll ask me, hey, Jeb, I have a 3.375. I have a 3.5% interest rate. Should I refinance? And it's like, well, I don't really know the details of that conversation. But when you hear that, what is your first thought, Josh? I mean, if you can lower, what's the golden number? Is it 0.5%, or is it,
yeah, think about this. This is what everyone kind of wants to go back to, that type of a rule of thumb. And if you go back to the 80s and the 90s, a couple things. Loan costs were much higher then, and loan amounts were much lower. So like your grandpa would say, hey, if you can't save 1% on your interest rate, it's not worth doing. Well, if you have an $80,000 mortgage and it costs $4,000 to refinance, it better be moving at least of 1%. Right now, loan amounts for the most part are much bigger and loan costs are much lower. If we get a property inspection waiver, which is an appraisal waiver where you're not required to get an appraisal, our total loan costs are $1,600. If you don't have it, then it's $1,600 plus the cost of the appraisal. So the cost is very low on that. So what we want to say is it varies by loan amount. And this is, everyone always asks, well, why is that a rule of thumb? Why does it work? I said, I don't know why it works. It just does. Run the numbers, pencil it out, and it's always enough benefit for someone to go through. So the rule of thumb is take $125,000 and divide it by your current loan amount. And that will tell you how much you need to save. So let's look at a couple of examples there. If you have a small loan, $125,000 loan, you take 125, divide it by 125, it tells you need to save a full % to really make it worthwhile. Now, let's take a more reasonable example, $500,000 loan. Take $125,000, divide it by $500,000. It's 1/4%. 1/4% is all you need to save. And for the most part, if we're getting that waiver on these clean loans with good credit, lower loan to value, because we've had 10 years of home values running up, we can usually cover it in a lender credit and do a no cost loan for those folks. And I believe that's the prudent point. Another question, people keep asking, well, what's going to happen with interest rates? Everything that I see on the horizon, and I read a lot of really, really smart people. I think I'm smart, but I read a lot of really, really smart people. And the consensus is that rates are either going to stay really low or move even lower. I would say if I'm placing odds on it, 2-to-1 odds, they're going to go even lower. So then I have the question, well, then shouldn't I wait? No, because it's a 35% chance they don't go lower. They could go higher. We don't know what's going to happen, and we're missing out on the gains or the savings on those payments right now. So run the numbers. If the numbers make sense, do it low or no cost, so you don't have a bunch of sunk costs in your loan, and take advantage of where the rates are right now. Another thing that people always forget is we can do custom loan terms. You don't want to just keep going and doing a new 30, a new 30, a new 30, and never get your loan paid down. We can match the loan term to the exact number of months you have remaining. I have some clients right now that they're like, I don't need a lower payment. Just give me my current payment and make it as short as possible. So we got a client doing a 24-year and 3-month loan on a 1-year-old 30-year. So they're not saving any money on their payment, but 5 years of payments going away on that.
That's huge.
So lots of options for how to structure it. And what I like to tell people is, if you talk to some kid in the call center and they're just telling you, hey, our rate is 2% today and there's no cost, so do you want to do it? Even if that were true, which a lot of times it is not, that's not the conversation you want to have. It's a mortgage planning conversation. Where are you at today? What are your goals? If we're not looking at all of those things of saying, what are the options? What's the lowest rate you can offer me? What's the cheapest rate you can offer me? What's kind of something in between? What loan term do we want to have? That's a conversation you should be having with your lender. When you had mentioned here a second ago, comment here, ask Jeb, ask myself if you need to work with a lender. We only do loans in California, but we're sending 3 to 5 loans a week out to good professionals around the country. Unfortunately, in our business, I would say 80% of the people are average to poor. For a large degree, the shysters are out of the business, so you don't have people that are cheating and stealing. But it's just as bad to go to someone that doesn't know what they're doing. Reach out to Jeb, reach out to me. We have a network of people around the country that will do a great job for you no matter where you're at. Just this last week, I had a South Carolina, a Florida, and an Arizona. We got all those people hooked up and connected with really good lenders that can have that kind of a consultation with you and walk you through all of your options and make sure that the loan isn't just, the flavor of the week or the one option that's on the board. It's the one that fits your situation and scenario the best.
No, absolutely. And I think that's a good parlay into our next conversation, because you just mentioned having that conversation with a professional. And I think that leads me into, the topic of working with somebody trying to buy a home, right? I received a call I actually received a referral yesterday from somebody looking to purchase. They need to get qualified. I put them in touch with you. And one of the conversations I had with that person prior to referring them to you was the conversation of, basically what my loan options are, and having a background in, mortgage brokering. I understand the mortgage business, and I'm able to have that conversation. A lot of agents are not, but I still don't leave myself to have it, right? I give them basic information and then put them in touch with a professional that can dive into the details. But one of the questions that came up was more or less like, what's the advantage of putting more money down? I mean, are my terms completely different than, say, putting 5% down? And I'll let you answer that, and then we can kind of get into the FHA conversation.
So the one that everyone knows, if you don't put 20% down,
Right.
you're going to be paying mortgage insurance of some type. So what will absolutely change is 5% down has a little bit higher mortgage insurance than 10% down, which is a little bit more than 15% down. And it goes away for the most part at 20%. So that's a big difference to look at. The loan level price adjustments vary by those tiers also. And when I say a loan level price adjustment, it would be awesome if someone had the type of memory that you could just memorize everything there. For really high credit scores, maybe two tiers have the same level of adjustments. So for the most part, you're not paying a ton more in interest rate. 5% will be a little bit worse terms than 15%. Mortgage insurance will be a little bit worse. With rates as low as they are, you and I have talked about, people don't buy a home price. They don't go out and say, hey, Jeb, I can afford this price of home. They go, this is my payment, and my lender has told me this is what that equates to.
Right.
So largely when we're looking at that now, I always want to say, if you're comfortable with this payment, we're setting something, without going down a rabbit hole, we're setting something called when your purchase indebtedness when you buy the home. If you put 5% down up to $750,000, whatever you put down, the loan up to $750,000 is deductible. The interest is deductible. So if we set that as high as possible, it locks you into the largest tax deduction. So again, it's that planning conversation. That doesn't mean that it's right if you have 20% down to do 5% and keep the money in the bank. But we deal with a lot of people that are like, I have this much money, I'm putting it into the home. I would much rather, if someone has 20% down, put 10% into the home and leave 10% in their bank account. And when we pencil that out for someone with a good credit score and they can see it on paper, that's the value or the purpose of that mortgage planning conversation. And then giving the borrower, the client, a side-by-side analysis of, these are what the two options are. Because what I always tell people is like, my job is to ask questions and present you with options. Yours is to make the right decision for you, because these aren't black and white answers. It's not this is the right answer. It's you need to have all the options laid out on the table, and then you make the decision of what works best for you in your situation.
No, absolutely. And so with that said, let's talk about FHA, right? So some of the pros and cons of doing an FHA loan, right? If you're out there in the field, or in the business at all, or maybe you're a home buyer and people have told you FHA isn't a good loan, or what have you, right? So there's kind of this this misnomer, if you will, of what FHA is, and I think a lot of people don't understand it, right? So if I'm going up against a conventional offer in some cases and I have an FHA offer, the agent on the other side may look negatively upon that FHA offer and not really understanding, the reasoning that buyer went with an FHA when they could have gone with conventional for whatever reason. That's a whole different conversation. But why don't we talk about let's start with the advantages of doing FHA.
So the advantages are pretty obvious, and that's why the advantages are one of the reasons why listing agents, when they're reviewing offers, sometimes will look down on an FHA loan. FHA is much, much more flexible on credit, like infinitely more flexible on credit than a conventional loan. So sometimes people will erroneously jump to the conclusion of, if it's FHA, they must have bad credit, which is not true. We do FHA loans for perfect credit borrowers all the time, but that's your number one flexibility, is additional credit flexibility. The second piece is debt to income flexibility. You can go to a much higher debt to income ratio than a conventional loan. Now, whether that's prudent for you and your situation is for you to decide. But in a tight affordability market where buyers are getting squeezed and being asked for highest and best offers, we can have some more flexibility and some more wiggle room to go higher on an FHA than we can on a conventional loan.
Okay, so I'm going to explain that in layman terms. Basically, what you're saying by a higher debt to income ratio means that I can actually qualify for more home in most cases using an FHA loan than I could say using a conventional, because they allow me to pass that certain threshold of
Yep.
what Fannie Mae and Freddie Mac would allow.
Yep. And
Right.
another sort of incorrect myth about FHA, back in the day, so before the meltdown, 2008, 12, 13 years ago, FHA loans and VA loans, because they have higher default rates than conventional loans, had higher interest rates. And after the mortgage market meltdown in 2008, the bond markets finally figured out that, hey, although Fannie Mae and Freddie Mac loans have an implied government guarantee, FHA and VA have a literal government guarantee.
Right.
These will never not pay off. And ever since that time, FHA and VA loans have had lower interest rates than conventional loans. So as an example, for a client I talked to this morning, we were looking at a 5% down conventional or a 3.5% down FHA. It was 3.25 for him with his 682 credit score. It was 3.25 for the conventional loan. It was 2.75 for the FHA loan. The FHA is going to have a much bigger interest rate. And at that, the 2.75 had like a $1,500 credit to him for his closing costs, where the 3.25 was just a 0-point loan. He wasn't going to get any credit towards his closing costs. So we like to point that out. The next biggest differentiator between the two is mortgage insurance. FHA, for a low down borrower, unless they have spectacular credit, the FHA is going to have a lower monthly mortgage insurance. FHA with a minimum down is 0.85% mortgage insurance. If you put 5 or more percent down on an FHA, that drops to 0.8. It's not really an advantage. So just call it 0.85. For this guy, we were looking at like 0.98 mortgage insurance on a conventional loan. So 0.5% higher interest rate, 0.13% higher on the mortgage insurance rate. But that doesn't tell the whole story, because in conventional's favor, there's no upfront mortgage insurance premium. On an FHA, part of how they manage the mortgage insurance fund and pay off on the loans that do default is they charge you an upfront mortgage insurance premium at closing. That amounts to 1.75% of the loan, and 99% of the time the borrower doesn't pay it out of pocket. They finance it onto the loan. So you're putting 3.5% down, but then you're putting 1.75 back on top of that. So you're going to end up with a little bigger loan. So my borrower that we're talking about could have had on his $500,000 purchase, he could have 2.75 on an FHA with 0.85 MI with 3.5% down, or he can put 5% down, have 3.25 with 0.9, it was like 0.98 mortgage insurance. So the FHA is going to have a much lower payment. He's going to have a higher loan on it, but he's going to come in with way less money to close. So that's kind of gets back to, there's not a right answer here. They're both good options. I mean, if we could go back to 2018 and tell buyers, hey, I can get you 3.25 on a 5% down conventional, they'd be ecstatic. So there's no right answer. The right answer is get them on paper, look at them side by side, and determine which one is best for you. And, going back to the whole thought of whether a listing agent thinks it's better to have a conventional or an FHA, if I'm looking at both of them, and Jeb, when the market tanked, I flipped over 40 houses. When we were reviewing offers of people looking to buy them, we never looked down on an FHA loan. We would go through it and say, give me the strongest buyer. If anything, FHA has more flexibility. It's less likely for that loan to get declined and get screwed up because of the additional flexibilities. At the end of the day, money's money. Whether the money comes from the bank or it's all cash from the borrower, the seller is going to get their net at the end of the day. Compare the nets and then tell me which loan is most likely to close. The FHA is more likely to close than the conventional. We close 100% of our loans. I can't tell you in the last 5 years we've had a purchase not close, but on your side of it, it doesn't always happen that way.
No, absolutely. And I tell sellers that all the time when comparing offers to them. One's a cash offer and one's a loan, and they're like, well, we have to accept the cash offer, right? And I'm like, no, we accept the best offer. I mean, if one is higher than the other or whatever the terms are, I mean, they're both money in the bank. You're not getting the money until the property sells, regardless of whether it's a cash or a loan. So at the end of the day, you shouldn't really care. Let's just look at the full terms of the transaction and make the decision from there. But one thing about FHA, and I will call this a con on the FHA side, is that appraisals, right? They're more likely to pick apart things in an appraisal, right? So if you've got an unpermitted addition, you've got something on a property. A lot of the stuff we see in Southern California, I don't know how other parts of the country are, but here we have a lot of things that have been converted, whether it's garages into rooms, or a patio off the back has been converted into a room, or maybe there's a door leading from the garage into a bedroom. Just certain things that aren't right with the property. Conventional isn't going to call those out in most cases, or they're at least not going to give them value with the unpermitted additions, where FHA, and at least in my experience, may be more stringent on that, and may come out and make a comment about that needing to be converted or permitted or what have you. What's your experience with that? And is there anything else that I'm missing on that?
For the most part, it's not an issue. What I will say, a couple, 2-3 times a year that we will come across with the FHA loans, on a pre-1978 home, where you have the potential for lead-based paint, they will not allow any chipping paint anywhere. So that comes up. They'll say, you guys scrape and repaint this. That comes up, like I said, 2-3 times a year, every year. The FHA regulations require the appraisers to do a visual inspection of the property. They're not home inspectors, but they are required to do a visual inspection. They make them stick their heads up in the attic and do some other stuff. So for the most part, unless they see something that is obviously a potential health and safety issue, it's not going to come up. So to me, for the most part, they're functionally identical. If we have a property that's in really bad shape, it could be an issue. On the FHA side, as long as the non-permitted addition doesn't lead to a health and safety issue or cause you a problem with not having enough parking, you have a converted garage and now you don't have enough parking to meet zoning for the area, there's some things that can come up. But usually, we'll just have our listing agents. If Jeb goes to list a home, and say, hey, well, just tell me what you got. We'll pre-flight it and make sure, hey, FHA we're good, VA we're good, conventional we're good, and then that way when your offers come in. Usually you guys are out inspecting properties. When there's something that might come up and be an issue on an appraisal. So for the most part, they're really not an issue, but we do end up scraping paint a couple times a year.
Okay, so what I heard was really good things about FHA versus on the pro side. The only negative was the mortgage insurance, which in both cases, you're going to have that, whether you're doing conventional or FHA. If you're putting, say, 5% down or less than 20% down, you're going to have that mortgage insurance. Anything else we're missing there on the downside of considering one versus the other?
The one that gets thrown out to everyone is back in 2008, the Obama administration, they made a change because there were so many losses on FHA loans. They made a decision to change the FHA mortgage insurance fund to make mortgage insurance permanent for the life of the loan. On an FHA loan, you can never get rid of it.
Right.
And that's brought up as a big negative. And I said, well, you don't really remember what the guidelines were before. It was on there for 11 or 12 years. You couldn't get rid of it for 11 or 12 years. Most people don't stay in a home and in the same loan for 12 years. So it was virtually permanent before. It is permanent now. And if the home goes up in value, there's ways of getting out of it. We can then go to a conventional loan. So it's made to be a big negative, and I would say it's a slight negative for FHA loans.
Got it. So we're at 23 or so minutes now. I'm going to wrap this up. Any last parting words? I guess, Josh, you have your contact information you can throw up there on the screen. I think I'll just kind of talk here. There you go. So there's Josh's contact information. If you want more, information from Josh, reach out to him directly. He also does live on Facebook and I think YouTube as well, a couple days a week. So you can search him on Facebook and or YouTube and join those lives, and you can also ask questions and all that good stuff during those events, and we'll do lives as well. But for now, we're going to leave it at that. If you have additional questions, do me a favor, comment below and or reach out to us directly. Thanks for taking the time to watch. See you soon.